Good afternoon, everyone, and welcome to our webinar, How a Trump Administration May Impact Shareholder Activism. Today's event is presented by commpro.biz, powered by Onstream Media, and is being sponsored by the law firm of Morgan Lewis. Please be advised that today's discussion is being recorded and will be available on demand later this afternoon. While the speakers will not be walking through a formal presentation, there are a number of thought leadership pieces and presentations that have been uploaded to the event website that are or will shortly be available to be downloaded at your convenience, but which will not be needed to follow along with today's discussion. We have a number of media representatives attending today's webinar. Pursuant to Chatham House rules, while the media is free to use information from the discussion, we would ask that the media representatives seek permission from any panelist they want to attribute a quote to. We are hoping to make this discussion as lively and interactive as possible and welcome your questions throughout the discussion. You can either send us questions using the Ask a Question feature of the webcasting platform or via Twitter using the hashtag Shareholder Activism. Again, that hashtag is Shareholder Activism. At this point, I would like to introduce our moderator for today's discussion, Keith Gottfried, a partner with the law firm of Morgan Lewis and leader of its Shareholder Activism defense practice. For some introductory remarks, Keith, the floor is now yours.
Well, thank you, operator, and good afternoon, everyone. As President Trump continues to build out his administration and as a new chairman of the SEC, the nominee currently being Jay Clayton is expected to be confirmed shortly by the U.S. Senate, it remains uncertain how shareholder activism will be impacted by the new Trump administration and its policies, and whether or not we will see a climate that is more or less friendly to shareholder activism. Our focus today is going to be to speculate. We're going to speculate to some degree how shareholder activism will be impacted by the new administration and what we currently know of the policies and some of the personnel appointments it has already announced. I want to be very clear that our goal today is not in any way to debate the merits of the policies that we're talking about. We're just really focused, and we are going to be focused, on how shareholder activism may be impacted. So if you hear some enthusiasm in our voices about how shareholder activism is going to be impacted, it's because that's what we do for a living. We advise companies or activists with respect to shareholder activism. And so we're focused on the shareholder activism world and how that little world is going to be impacted, not so much whether or not we agree or disagree with a particular policy that is having that impact. I'm extremely delighted to be joined today by a panel of professionals and also very good friends with extensive experience in activism, including a number of folks that I've had the honor to work with on a number of activist defense matters over the years. Their impressive bios are included on the event website, and I'm delighted, particularly at a very busy time for all of us, that they were able to find time in their busy schedules to prepare for and participate in today's discussion. First, Stephen Balet, Managing Director with Strategic Communications at FTI Consulting. Steve is the head of its corporate governance and activist engagement practice. Stephen Brown, a senior advisor of the KPMG Board Leadership Center and a leading expert on corporate governance issues, and our kind of representative of the institutional investor community as the former head of governance at TIAA Craft. Art Crozier, the chairman, co-founder of Innisfree M&A Incorporated, leading proxy solicitation firm, well known to anyone involved in the shareholder activism arena. And last but not least, Duncan Harrington, the managing director and head of activist response and contested situations at Raymond James. And let me just note that this is the third in a series of webinars that we're doing on kind of the political aspects of shareholder activism and kind of the relationships between politics and shareholder activism, how shareholder activism is being impacted. Duncan was with us for 2 webinars ago, the first of the series, and then Duncan was in the midst of changing firms, and so was not with us on our last webinar. And now Duncan, very glad to say Duncan was recently named the head of activist response and contested situations at Raymond James. And so now we're delighted to be able to have Duncan rejoin us for this webinar and get the benefit of his insight. So welcome.
Pleasure to be here. Thanks.
Well, thank you, Duncan. Thank you. And welcome, panelists, and thank you for being with us today. Before we discuss how the new administration is going to impact shareholder activism, or how we think they're going to impact shareholder activism, I think it'd be useful to go back in time a little bit, not too far, and go back to November 7th, 2016, the day before President Trump was elected. And if this group was having a webinar on November 7th, and our topic at that point being what is our outlook for shareholder activism 2017 and beyond? What are we seeing based on what's happened in 2016 and the trend lines? What are we seeing, and what do we think is going to be the case? And let's remember that I think most pundits, when they got up in the morning on November 7th, 2016, would have had a different prediction for the outcome for the election, as would a lot of people. And so if we were having that webinar on that particular day, I think we would have probably had somewhat of a different perspective of where the trend lines were going. And so just to go back not too far in history, and I'll ask the panel to join in here, as I think about 2000, that period of time, we're finishing up the 2016 proxy season. We had, and when I cite some statistics, and without attribution, let me clarify that unless I specify otherwise, we're talking about statistics from our friends at FactSet Shark Repellent. So there were 319 high-impact activist campaigns from 2016, which was a decline from 377 in 2015, but still a healthy year for shareholder activism. There was some concern espoused that hedge funds were having activist hedge funds were having not the greatest year, and that the trends where they had been gathering increasing amounts of AUM or assets under management, that maybe some of those trends were going to be reversing, and that we were seeing some withdrawals and some redemptions, and some people questioning the performance of those hedge funds. Now, as we all know, when we got to January 2017, things turned around remarkably. But as we're sitting there in November 2016, that was a fact, a trend that was on the table. The other thing that was on the table is we had an SEC that had a number of proposals in the hopper. In all fairness to the SEC, a lot of the work that they were doing was created by the Congress and by Dodd-Frank, and it wasn't just that the SEC was trying to be creative and come up with more regulations. But we had CEO pay ratio out there, a lot of time and money being spent figuring out how to comply with that. We had universal proxy, a rule that the SEC had proposed that would have provided for universal access to the proxy card, and done away with what we call the modified nominee rule, and there was some concern that rule was going to make it easier for proxy fights to be brought. It was an interesting rule because I don't think there was a groundswell of demand for the rule from either the activist community or the company side, but nor was there a piece of legislation driving the SEC to do that. But that was on the table. There was also a bill called the Broker Act that was proposed by Senator Tammy Baldwin that was going to seek to regulate 13D Section 13D, amend Section 13D to deal with what people call the Wolfpack problem. And there was some stuff coming out of House Financial Services Committee with respect to regulation of proxy advisors. So clearly, when we look at November 2016, we were seeing more regulations coming from both in law from the Congress and from the SEC that would have an impact on shareholder activism. We were also seeing an environment where large caps did fairly well last year in terms of being targeted. I mean, large caps it was a record year for large caps being targeted by by activists, even though, as is normally the case, small caps still represented the vast percentage of activist campaigns. 75% of activist campaigns were companies with market caps of $1 billion or less. So I think that's basically where we were on November 7th, 2016. Any panelists that anything I missed out there in terms of the landscape, Art Crozier?
No, I think you've got it, Keith. I mean, I think the one, just cutting it a little finer on hedge fund activism and the trends in 2016. As you noted, the number of campaigns went down slightly, but what we saw, though, was a lot of the large activists, the folks who had been very active previously, a lot of them held back, and I think that partially accounts for the smaller number of mega caps being targeted. But the other thing was that you saw a lot of new entrants coming into the activism field, either folks who were starting up as activists with smaller funds, or what are called, reluctivists or occasional activists, long-term institutional shareholders who, have decided to get into the act themselves and do their own campaigns. I think that increase in the participants in the arena was a significant trend for 2016 that probably would have continued. And again, also, I think we saw, the reduction in the size of the companies being targeted. But as we also saw, I think in the second half of 2016, as a lot of the hedge funds who had performance issues in 2015 to the beginning of 2016 kind of righted their ship, they were starting to get more active as well in the later part of the year.
Steve Balet, any other trends that you saw that we were headed towards and as we came out in 2016? All right, Steve might have us on mute for a moment.
Sorry, Keith. One of the things that Art said, and I want to just expand on it as a trend, is that activism has been a strategy for a while. I think there was a transformation process in 2016 with what Art described as reluctivists or occasional activists, as activism becoming a tactic for institutions that weren't activist-only funds. And we saw just a great deal of proliferation of that in 2016, particularly towards the end, of firms that don't use activism as a strategy, but were using as a tactic of engagement. And I think that was one of the leading trends of 2016.
Okay, so now we get past 2016, we get past Election Day. Our 45th president is inaugurated last month, fills out his cabinet. One of his early picks was Jay Clayton to be a SEC chairman nominee, who most of us know is a partner at a very prominent law firm, Sullivan and Cromwell. Clearly, Mr. Clayton has a transactional background, public company transactional background, and different than his predecessor, different than the enforcement background. How do we think the new leadership of the SEC, and let's also remember we have an acting chairman now, who is a Republican appointment, who is the acting chairman because there's no one else to be chairman right now. What do we think the new under the leadership of Mr. Clayton? What do we think? How is the SEC going to be different with respect to shareholder activism?
Hi, Steve Balet here. I mean, I would say that from the top down, from President Trump down, and his statements concerning regulation, and his adverseness to additional regulation, we are looking at some of the things that you mentioned describing November 7th as probably some things that will come off the table. CEO pay ratio, although part of Dodd-Frank, as they're taking a look at Dodd-Frank, may come off. I cannot see this administration and the new SEC pushing for companies to pushing for regulation which will cause companies to take actions which will be an expense to those companies. So those types of regulations, the add-on CEO pay ratio, possibly changing to a universal ballot, those types of pushes will probably have to come from private ordering rather than from regulation through the SEC.
In fact, Steve, I think it was last week that House Financial Services Chair Hensarling put out a memo to the House Financial Services Committee leadership team, a memo that has been widely dispersed around the internet, that universal proxy is on his list of one of the things to be shelved. And I think there's some specific language directing the SEC not to move forward with the proposed rule. And let's just remember, this SEC chairman, like the previous SEC chairman, will in many ways take his instructions from the administration, from the Congress, and while there is some room to do some of his own initiatives, I think largely he'll be taking direction from the administration and the Congress, and particularly the House Financial Services Committee. So it looks like universal proxy is dead. Does anyone disagree that universal proxy is going to come back to life?
Yeah, I don't think so. And I think, to come back, to come back to the broader topic, the president signed the executive order, I think last week, calling for, a top-to-bottom review by all agency heads of financial regulations, aligned with 7 core principles that he outlined that he described in the executive order, and so I think there are a lot of things that are up for grabs. If you look at the core principles, while they're very broad and will probably lead towards a lot of dispute as to how you actually interpret them in light of the financial regulations that are in place, they're not terribly shareholder friendly from their appearance.
Keith?
But the other side of the coin is, he does have Carl Icahn appointed as kind of regulatory czar with particular reference over the SEC. So, exactly how that kind of push-pull dynamic is going to work is probably be very interesting to see it play out.
Stephen Brown, I think you were trying to get in here.
Oh, sure, but that was an excellent point that was just recently that was just said. The difference between November 7th and November 8th and 9th is that you do have Carl in his ear and someone like that in the president's ear. The other thing that was a trend in 15-16, which I think will continue, is the concept of private ordering. And that we saw investors use the private ordering process through the shareholder proposal process for proxy access. And as we think about the SEC being getting its orders through Congress and shutting a couple things down that have been in the works, like universal proxy, I think you'll start to see private ordering. It doesn't take a year. It takes a little bit longer than that if you look at the process of private ordering with proxy access. But that's going to be a trend that's not going to stop for years to come, that shareholders use their power and their strength and their coordinated power and strength as they talk to each other at various gatherings, as they're allowed to do, around governance issues without being charged with collusion or anything like that. They're going to keep talking and figure out what issues should they push through the shareholder proposal process.
Yeah,
that's an interesting point. Sorry, this is Duncan, by the way. That's an interesting point because I think one of the effects of that could happen or that we'll see in the upcoming year or years is that, when we rely on private ordering to help bring about some of these changes, that will mostly be focused on reforms on the issuer side, whereas some of the things at the SEC level that are going to be some of the initiatives there that are going to continue to be backburnered, like the 13D reporting window and some of those things that some issuers might want to see happen. They give them a bit more insight into what shareholders are building a position in their company they know sooner. Those are the types of things that will continue to probably not come into place. So the power dynamic then kind of can shift in a way where it will continue to give shareholders additional rights or access to information and disclosure obligations on companies, but then some of the types of disclosures the companies would like to see in return, again, probably won't. You're not going to see those come about anytime soon.
Yeah, and I think that's an excellent point, guys. I think that we are going to see more private ordering. Proxy access today came about through private ordering. 14A11, almost 5 years ago, got struck down. I think 6 years ago, got struck down by a federal court. Even on universal proxy, all we would need to have is the commission to make a relatively small change to Rule 14A4D1 with the bona fide nominee rule, and you could have a form of universal proxy. So I think we probably will see more private ordering, and consistent with the whole administration's public position that they want deregulation. Deregulation is something they really want to push, and probably are going to be real hesitant to drive any additional regulation, particularly at the SEC as impacts shareholder activism.
Yeah, and I think a fascinating, to me at least, a fascinating point about proxy access as the path or the signpost for private ordering in the future is when you think about, Keith, as you said, proxy access started as an SEC rule, 14A11, about 5 years ago, got overturned in the courts, and the institutions took it up through private ordering, through shareholder proposals, and what the consensus that we have now on the form of proxy access is almost identical to that original 14A11 rule.
And I believe it's now at almost half the S&P 500 companies.
Yep.
Yeah. I think a lot of companies have made this point that had 14A11 not gotten strucken down, it would have been a lot easier than the private ordering process that we've actually gone through. And all the back and forth about the different forms of proxy access, that at the end of the day, the proposal that the SEC put out there some 6-7 years ago was, in retrospect, not all that bad. We mentioned Carl Icahn. It's impossible to have this discussion on the impact of the Trump administration on shareholder activism without talking about Carl Icahn, given his announced role as a advisor to the president. I think the term has been used as advisor on regulation or deregulation. However, whatever the title, however informal, he's clearly going to have the ear of the president. Mr. Icahn is probably the most famous activist investor with probably the longest longevity of any activist investor, and he's also not just an activist investor. I think it's fair to say he's also he's been a businessman for many years, and so one of the questions to talk about is, do we think Carl's role as an advisor to President Trump is that going to be more helpful to the activist investor community, as he's going to be someone who's going to be pushing for things that might benefit the activist investor community, like universal proxy, which he has indicated that he supports, or do we see Mr. Icahn as more somebody, given his business background, who's advocating for the business community and is really more carrying the water for the business community and saying, what do we need to do to help grow gross national product and the economy and things of that nature. Panelists, any thoughts on that? Where do we think, which direction do we think Mr. Icahn is likely to have a greater amount of influence and a greater amount of interest?
Well, historically, Carl has not been a big cheerleader for boards of directors and CEOs of publicly traded companies as a general matter. So, I think his bent will be not to support, a more board of directors, corporate-centric regulatory scheme, just based on what he said in the past, but, clearly has done a terrific job of making money and taking over some companies and, causing them to operate more efficiently and delivering value.
Yes, I agree. This is Stephen Brown. And I think I said this before, that the investment community, particularly the hedge fund community, is better off today with him there than they were before November 8th, because he has the president's ear. There are a lot of other people who have the president's ear also. But having a close confidant who can explain some of the nuances of some of the proposed laws or the intended effect of different things is quite unique. And what I'm about to say is absolutely true. It's going to be funny, but it's absolutely true. They both, the president and Carl Icahn, have the same sleeping patterns. And those of you who have Carl, have been on the other side or have been worked with him, know that he just doesn't sleep, and he'll call you at 1 o'clock in the morning. And while that is an interesting note, the serious side of that is, those 1, 2 o'clock in the morning conversations, are pretty interesting because there's no one else around to tell you differently. And so that's why I think it's a very interesting space where the investment community finds themselves in now than a year ago.
One interesting thing is that both President Trump and Carl Icahn have, they both wear the hat of the businessman and the investor, and so I think you will see a little bit of both of those from Carl. I mean, he's there as the special advisor on regulations, presumably are acknowledged to reduce and simplify them, and he's called out some specific things like Dodd-Frank and the impact on banking, and some of the environmental rules on oil and gas companies, and all of those things will be pro-business. But I do agree that his overarchingly between the two competing sides of him, I think he's been far and away a bigger supporter of corporate governance changes and reforms and shareholders' rights vis-a-vis the company.
And I also believe he will be the protector of the status quo for the 13D disclosure rules. There was some movement to try to change those from both the left and the right, and I think that Carl will be the main advocate for holding the line for the 10-day rule and not shortening that period of time.
But it also has to be said that the cabinet and the appointees to date have far more people who have served on boards of publicly traded companies and senior executive positions than any cabinet before. So there's the potential for a really interesting kind of push-pull dynamic between those two, the cabinet level folks and Carl Icahn.
Yeah, I mean, I think at the end of the day, Carl wants to make money, and he's going to spend his time probably in an area where he has the greatest ability to see the growth in business opportunities in general, and and that might be just in spending his time on deregulation in general, and not so much on whether or not he could get convince the administration that there's this compelling need for universal proxy, which I don't think any of us really believe there is a compelling need for. So, but time will only tell. So, we talked about Carl's role in is the deregulation czar, if that's the right term, and so deregulated environment would be intended to open up numerous opportunities for companies, large and small, and so in that deregulated environment that will take time to come to bear. Only so much a president can get done through executive order. Eventually, we need to see bills and legislation passed, etc. Do we think that deregulation? Do we think that itself, deregulated environment, separate from deregulation of activism and activist situations, just deregulation in general? Do we see that driving shareholder activism, particularly companies that an activist may see as not taking full advantage of the market opportunity that's created?
Keith, this is Steve Balet. I think you nailed it right on the head in that activists, the difference between activists and companies in a lot of cases is a question of pace. And we'll see deregulation and we'll see companies adjust. But in cases where companies, from the activist perspective, are not adjusting to the new dynamic quickly enough, that is where they believe they will have an opportunity, and that is where I believe we will see a number of cases of shareholder activism pushing companies for changes quicker, or possibly pushing for changes that are more extreme than the company is considering.
And Duncan, your firm focuses a lot on middle market firms, on middle market companies. We've talked about how middle market is, 75% of activist targets are in the middle market. Would you think that smaller companies, the pivot that you need to do to take advantage of the market opportunities created by a deregulated environment, it might be easier for a larger company that's got a big in-house legal department and lobbyists, etc. Smaller company, not so. Is that going to create some M&A work? Is that going to create some M&A opportunities where companies that see potential opportunities in the mid-market that go after the companies that aren't able to take advantage of them, and there are opportunities and synergies in consolidating?
Yep, absolutely. So I think certainly for small and mid-cap companies that might not have the internal resources, like you mentioned, Keith, to respond to some of the macro changes in the regulatory environment, I think you will tend to see an effect that, and for those sectors that are broadly advantaged by deregulation, what you can sort of see is it will separate some of the stronger performers who are able to change and adjust to the new environment more quickly. We'll start to separate from and leaving the ones that are kind of trailing behind to separate, I guess, actually from the pack that's that's being buoyed by the deregulation. And I think you certainly see in the smaller and middle cap arena with activism, M&A being the much more prominent demand, just because smaller activism targets are, it's a lot easier to find a buyer for a $500 million market cap company than a $50 billion market cap company. And so I certainly think in some sectors you'll start to see some of those underperforming or slower to evolve and change companies getting acquired.
Yeah, and I think that's right, and you may see it particularly in the small to mid-sized banks, to the extent that they do modify Dodd-Frank and raise the level of assets above $50 billion to qualify as a SIFI, a systemically important financial institution. That could open up as that number goes up. And they're subject to less regulation as a result. You could see more of a market in M&A for those banks, which could attract activists in the stock to try to get them to sell into that more attractive market.
Yep, go ahead. I was just going to say, at the moment, activism for financial companies in this market cap range is a bit down, mainly because of the surge in the market after the election and the anticipated impact that will have on banks. Their market valuations, relative to their book value, is so high right now. It's hard to justify M&A for some of those companies. But I think what you will see is exactly in line with what Art was saying. Once you start looking at the results from some of these companies, how they're able to respond to changes, you will see kind of a separation of the ones that are not as quick to adjust, and those ones will could potentially be more likely to be put into play.
Yeah, and as I think all our panelists know, last year the number one industry that was targeted by activists was the financial sector. A group of us spent some significant amount of last year working together on a defense for a bank that was a successful defense. But it looks like, in the deregulated environment, we may see even more activism in that area this year. Maybe after the market catches its breath, Duncan.
Right. Yes, exactly. I think that's exactly right. I think the current valuations of banks right now are more an expectation of what the changes for banks are going to be and how they're going to and how the banks are going to benefit from that. But I think once we get down the road, and like you said, Keith, it can be time before some of the changes come into place and take effect, and then for the market to see how the different banks, how they respond to that and their performance, a couple of quarters or a year down the road. But I absolutely think that it will, even though it's been a decrease in financial activism, at least for small and mid-cap banks so far this year, it will increase.
Go ahead. I'm sorry, this is Steve Brown. If I can add, mid-caps have traditionally been the targets of activists, no matter what industry. It was only a few years ago where activists went upstream, really upstream, and now they're returning back to look at the mid-cap space. And as always, the primary targets are those that are value plays with perceived operational issues in the context of what we were just talking about in terms of deregulation and the ability for these firms to take advantage of that deregulation. If you do not take advantage to where your peers are, your prime target for a value play and an operational play for activists to come in. And I believe Duncan said earlier, these are shops for the most part, resource constrained and not having a terribly large IR or governance department of lawyers who are going to be prepared. And so I think this space will be absolutely ripe for targets of activism.
So we've already mentioned the stock market levels, where the market's trading. I haven't looked at it in the past hour, but earlier today it was at 25. Dow was at 25.97. Nasdaq 58.06. Record levels. Great time to be in an index fund. But now with the market, those valuations so strong, and none of us are prognosticators of where the market's going to go, or whether or not how much room higher, or et cetera, whether or not it's time for correction. But given that the market is at the very least in a healthy pricing environment, does that support the argument that now might be less of a time to be putting money, if you're an institution, to be putting money in index funds, and more now of an opportunity to be looking for who are the really talented active managers, stock pickers, because there isn't much more. Maybe there isn't a huge amount more room to go in the index. Does that help the activists in terms of gathering more AUM at the moment?
Yeah, I mean, yeah, certainly, absolutely. I think that, you know, for exactly the reasons you said, in that type of environment, investors, you know, once the markets reach out, you know, this type of level and these types of valuations, then, you know, it's hard to justify really much higher kind of multiples than you're seeing in a lot of industries. So in order to still get that return or that alpha, you have to look for more of the active managers or more, you know, event-driven type investors. And I think you'll see that you know, what we're seeing, at least in the middle market, is that, you know, M&A activity, at least in the last few years, has been, you know, significantly higher than it had been versus kind of the years previous. And so far this year, it's tapered slightly, but it's still pretty robust. And I think that you see, you know, cash held by both strategic buyers and PE funds at you know, at very high levels. And I think there's a lot of, you know, PE-owned portfolio companies that have been held by a large for several years, so there's a backlog there. And I think that all these things are going to help actually buoy the M&A activity in a lot of different sectors. So I think those, you know, I think even in some sectors, I think some sectors are a bit frothy at the moment where you might see M&A taper off, but I think in some other ones, you'll still continue to see some activity that's going to drive, you know, help drive some activism in those areas. And I think that, you know, that will, in addition, kind of draw more interest into of investors into activist funds.
I mean, because the large caps, if you look at the large caps where their stocks have done very well, they've got good currency. If they were going to do a stock deal, they've got good currency. Cash is still relatively cheap. But then in that mid-market, small market sector, not all of those companies have been buoyed. And so if I'm an activist, Doug, I might be really focusing on some of those companies that did not pick up on the wave, right? And I'd say now is the best time to be acquired because these larger companies have got currency, are looking pretty good. And so from the small cap mid-market perspective, this is a time to be concerned.
Yeah, absolutely. I think in a rising market where it does sort of have that kind of effect of separating the wheat from the chaff, so to speak, and especially where there are a lot of buyers who, like you said, have good stock currency, a lot of cash on hand, and, you know, interest rates still very low. It's certainly that type of market for sure.
One of the things that President Trump talked about during the campaign, and I don't think this has gotten a huge amount of play in recent weeks, but he's talked about tax reform, and the House and the Senate are also very interested in tax reform, at least the Republican-controlled part of the House, and Republican-controlled part of the Senate. And one of the ideas that the president bandied about quite a bit during campaign was the idea of a repatriation tax holiday, the idea that you have all these companies that have significant amount of cash overseas, particularly technology companies, pharma companies, and that if we were to find a way to be able to allow those companies to bring that cash back into the U.S., that without paying a substantial amount of taxes, that would have some beneficial effect to the economy. I think one estimate from Moody's is that there's $1.3 trillion stashed overseas. And I think the last proposal I saw from President Trump was a one-time tax rate of 10%. So obviously we've all seen activist campaigns focused on companies where the activists thought there was too much cash on the balance sheet and wanting to special dividend or stock buyback, et cetera, focused on use of cash, getting the cash off the balance sheet. Do we think a tax holiday itself, a tax holiday such as what President Trump has suggested, obviously devil's in the details, particularly the restrictions on what's the restrictions on the use of the repatriated cash, do we think that that's a catalyst for activism in 2017 or whenever that tax holiday gets put into motion?
I think it likely will be. I mean, I think if you look at the last big tax holiday that was done in, I think 2004 or 2005, at that time it had restriction. That tax holiday had a restriction on what that cash that was brought back to the U.S. could be used for. It had to be reinvested in the company. But I think what was kind of uncovered, in some academic studies later was that, for every dollar that was brought back on shore, it freed up actually cash already held in the U.S. that could be used for whatever you really wanted to use it for, whether it was a distribution to shareholders or by other companies or whatever. And I think the results of some of the studies indicated that of all the money, I think something like in 2005, something like 7 or 8 times the amount of cash was brought back into the States and had been kind of the typical level for the years before that. And of all that money that was brought back on shore, over half of it was actually indirectly distributed back to shareholders, usually in a form of a one-time stock buyback, because it freed up domestic cash. So I think what will be interesting to see is a couple different things in this iteration of it is if there's some type of, expanded time limit that companies have to take advantage of the holiday. And again, we've talked about some companies being slower to be able to respond or actually comply if it's something that has some kind of a mandatory element to it. There could be a lot of pressure from shareholders to accelerate how quickly they and to the extent the size that they do those types of things. And I think also to the effect of to the extent companies use that cash indirectly to do other things rather than distribute that cash to shareholders if it's done for M&A or it just sits on the balance sheet, there's going to be a lot of shareholders who are going to have thoughts about what the companies are doing with that capital and is it being put to the best use.
I couldn't agree more, and the facts that Duncan's talking about from the last tax amnesty, I believe it was although there were restrictions on what the money could be used for, it was very difficult to police. And in the end, a great deal of the money was redistributed to shareholders. I think one of the aspects that could happen in a repatriation is if companies do choose to use those funds for something other than a distribution, such as a merger or an acquisition, that's where you can see activism, as we have seen lately, at acquiring companies, asking them to cancel a planned acquisition or to stop a planned merger, and instead redistribute the cash that they would spend to shareholders. So it's going to be very difficult, in fact, for companies to do something other than redistribute that cash in an activist environment.
Yeah, I mean, it'll be very interesting to see how it plays out in that, at least something I just saw recently, is that of the amount of money that's offshore that can't be brought back, something like 2/3 of it is owned by 30 companies, and a high percentage of those are tech companies who are not exactly known for distributing lots of cash to their shareholders. So exactly how that dynamic is going to play out, particularly at those companies, will be very interesting to see.
So one of the trends that activists have benefited from in recent years, and one of the things that a number of people would say have, including I think almost all of us, is that they've benefited from an extended period of low interest rates, which not only has it made it inexpensive for companies to lever up, to borrow money and then do special dividends or buybacks, but it's also made activists in hedge funds as an investment class, made them attractive, because if you're an institution and you're looking for alpha, obviously treasuries and the like are not going to be that super attractive. But now we see the Fed moving somewhat slowly, but definitely moving in the direction of maybe a less facilitative interest rate environment, some tightening of monetary policy, and who knows how the current stock market run influences the Fed's actions. But do we think that a rise in interest rates, however gradual they are, is that going to adversely affect shareholder activism over the near term? Duncan, our resident investment banker.
Yeah, at the moment, I mean, look, there's only really one way rates can go, and they're, gradually moving in that direction. But at the moment, rates are still very low, and like you said, Keith, and so I don't really see it having a huge impact in the near term. It could be over time if rates get high enough. It could put, pressure on, activists and really, lots of different investor classes to, really generate a strong return over, kind of a lower risk rate. But I don't really, in my opinion, I don't really see it in the very near term having a large impact.
Okay. Anyone have any different view?
That sounds right.
Yeah, I agree. I think we have consensus that interest rates, even if they're headed up, in the absence of some dramatic shift by the Fed, not likely 25 basis points here and there, not likely to impact activism in the near term. One of the things
I think the other thing too is that it's also hard to kind of isolate out, just the interest rates, because I mean the effects are also going to depend on what happens with tax reform, and what happens with general economic policies as well. So, and a lot of that is still to be written.
One of the things, so with Donald Trump being I think in recent history, the first president that had a business career for most of his adult life. I mean, other presidents operated a business or had a business, but had a political background fairly soon thereafter. But when we look back on President Trump's business career, activism was never really an area that he intersected with, and I don't recall activism ever really coming up. I mean, this is not an area, and tell me if you guys understand something different. It's not really an area that he's particularly passionate about. I mean, obviously, Icon's got a lot of experience and a huge amount of experience and interest in the area, but that's not President Trump. I think if I stretch my memory, I think you've got to go back, maybe 30 years ago till the days of, I think, President Donald Trump had that back and forth with the late Merv Griffin over the resorts. So I guess there was some activism. There was some the battle over Resorts International and who was ultimately going to own the Taj, et cetera. That's some 30 years ago. But I think other than that, and that's a long, long time ago, it's not an area that he's really ever been involved in, and nor has, when you look at the family, nor have they been involved in. So it's not like he comes to the area and said, this is something that I've got some ideas about. This is something I've got an agenda on. Do folks agree? I mean, is that everyone's understanding?
Yeah, I'm not aware of him being involved in anything truly like activist or activism like in nature on either side of the coin. So, probably don't think it's something he's really considers or is that much on his radar actually. But which is funny because a lot of the things we see and hear in the media about President Trump are almost kind of have some parallels to activism in a way because, we'll see news stories about that, he'll call out companies publicly and criticize them for, doing something they've done, or he'll kind of, try to, call them out and bully them a little to force some change in some cases. And, he's viewed, or he views him, portrays himself as the guy who's sort of the art of the deal kind of guy, and having Carl Icahn as his advisor, and all those sort of parallels to activism in my mind, just seem like it's just surprising that there's there's just been sort of that absence of it from his past, actually, in my opinion.
Yeah, because he definitely ran an activist-oriented campaign, and that's what got us all the idea of let's do this webinar back in the end of last year. It was September, November, October, that the parallels between a political campaign and an activist campaign that this whole group was on, because he really, every time you looked at the political his campaign, you kept thinking, this is really activist campaign. I mean, this is very similar to what we would be dealing with day to day in dealing with activists. So probably ran the most successful activist campaign of all time.
So if I could just jump in here, which I think you're right, and we haven't really seen him in his past a great deal of actual focus on activism, but with all these things, activism alike and also from political campaigns, it's the peripheral or the facts in the peripheral that really matter. And this is where I think having Carl Icahn in his ear is of great interest, because he can sort of give the details around potential legislation as opposed to a lot of the issues that were driving the legislation for the last few years, at least proposed legislation. Like the Brokaw Act is named after a town in Wisconsin, which was activists were blamed for beating up the company and the different machinations that went on with that company because an activist was involved. And, that sort of drives legislation. And over the last couple of years, a lot of the proposed legislation are derived off of these optics. And we're in a very interesting time where you have the optics of populism, you have the optics of wage gap issues, and activists are extremely wealthy people who come in and have an effect on companies. And it's whether you think they're a positive effect or a negative one that tends to lead the day. And so that's what I think makes these times very interesting, of which way the administration is going to go when it has a mandate from a populism mandate given the election, in getting the legislation correct that's going to appeal to the masses who could care less of the intricacies of how activism works and who gets to call the shots inside of a corporation.
As we get to the top of the hour here, I thought it might be helpful as we work our way towards wrapping up is some conclusions, preliminary conclusions as to the impact of activism. I think one would be that generally, whether you like the policies or favor them or disfavor them, generally the administration is probably going to be more facilitative of shareholder activism than past, or the policies, intentionally or not intentionally. I think shareholder activism is probably going to benefit and be driving forward by the administration's policies, and certainly not adversely impacted. Anyone disagree with that? Color on that?
No, I agree with that, Keith. Again, I think there's a lot of crisscrossing dynamics, but net, I think it's right that when all is said and done, whether it's through the tax holiday, whether it's through regulatory changes or private ordering by shareholders, that there will be we'll see a return to high levels of activism in 2017.
Yes, and indeed, here at the Board Leadership Center, we spend a lot of time talking to boards, and we have to raise things up to the 50,000-foot level. because they're board members and not part of operations. And when we think about trends and when they ask about what do you think activism is going to do this year, our message is stay the course from previous years and preparing for it and making sure that your engagement is where it needs to be and your defenses and your teams are in place. And if they're not in place, so quickly move to do that, because we think where activism was last year is where it's going to be this year, if not greater.
Yeah, and I think, go ahead.
Oh, no, I would agree. I'd say that, and Art spoke about all the different changes that may be coming, which may lead to more activism. To just narrow that down, I would say that in terms of what's immediately under control of the administration, which would be, in an area of regulation, that we'll probably be able to see an increase in activism in highly regulated or previously highly regulated industries such as finance and energy and anything that has to do with the EPA. Those are areas where I would kind of focus on and take a look at, and I believe activists will as well, to take advantages of the changes in regulations or the elimination of them.
And I think another preliminary conclusion we can make is that Carl Icahn is going to have substantial influence in the administration, whether he has a formal, informal role, whatever his role is. He's going to have some substantial influence, and that whether he's focused on helping, intentionally helping the activists or helping the company, pursuing a deregulated environment, if that is his charter, the deregulation effort, that in and of itself should probably help drive further activism. And it's not a zero-sum game. It doesn't mean that companies are necessarily being adversely impacted, but because activists see this substantial market opportunity for a lot of companies, and if the companies don't take advantage of it, then the activists would be inclined to jump in and see if they could be a catalyst for getting the company to take advantage of that opportunity. Is that another fair preliminary conclusion?
Yes, I think so.
Mm-hmm.
That I think another one would be that the last year, if we saw 75% of the activist targets being small mid-caps or companies under $1 billion in market cap, that we're going to continue to see a big year for the small and mid-caps being targeted, probably even more so because of the market valuations we're seeing and the fact that the tide may not be rising all boats equally. And so activism is going to continue over the next year. We can't even say season anymore because we don't even know what that means. We know what annual meeting season is. We don't know necessarily what proxy season means. But that it will still be a small to mid-cap area that will be targeted, probably increasing. If it's 75% in 2016, it could even go higher in 2017.
Yeah, and I think you may see a return. I mean, not to the mega cap companies that have been targeted in like 2014, 2013, 2015, but I think you're probably going to see larger companies being targeted again. As some of the bigger players, the larger hedge funds who had kind of stepped back after the poor returns in 2015 and early 2016, kind of get back into it again. We've already seen Paul Halal go after CSX, and Elliott is after Arconic. So I think it's still going to continue to be mid-cap, primarily mid-cap focused, but I think we might start to see, a good number of larger cap companies involved as well.
Another one would be that we'll see an SEC that is less focused on rulemaking per se, and probably less inclined to extend any initiative in rulemaking around anything regarding activism, and probably we'll have a fair amount of pressure on it to ease up on some of the disclosure rules that folks might believe unfairly impact, from a cost perspective, smaller public issuers. So, not likely to see the SEC coming up with things like the proxy access rule. I'm sorry, not the proxy access, universal proxy rule, in the absence of a specific congressional mandate to do something like that. Agree? Disagree?
Agree.
Okay. What other conclusions are there, that preliminary conclusions, that we could set forth today? Is there anything else, Steve Balet, that you think that we could come forward?
I think that, and this is tangentially related to the administration, but we've just seen a rising amount of short activist attacks, something that we weren't really concentrating on today, but activists publicly promoting and pushing short positions in stocks. And there may come a point this year or next year where companies begin to take the complaints about these short attacks to the administration and look for some type of relief. I don't know if they'll be successful in that attempt, but that could be something that we see over the next year and a half.
Steve Brown, I think one that I left off here that I should have mentioned is the balance of power between corporations and shareholders, and notwithstanding Mr. Icahn expected influence that he'll have, that we probably will see a decline in the influence from the shareholder-centric model that we've been heading towards. I think the pendulum will move a little bit away from that. And one of the things in that memo from the House Financial Service Committee Chairman Hinsarling, which is it's a 5-page memo, and you really got to look at it with a highlighter. But one of the things it does say is modernize the shareholder proposal and resubmission thresholds for inflation. And obviously he's referring to Rule 14A8, and that's not directly hedge fund, economic activism or governance activism, but that there was 400 shareholder proposals under Rule 14A8 that were brought in 2016, and something like 300 that got to a vote. I mean, it's probably in the cards, and probably not going to be a huge challenge for the administration to do something with Rule 14A8 to modernize it and push that pendulum away from the shareholders.
Yeah, and it will be interesting because this is something which over years, perhaps decades, folks have always looked at and said, look, we got to raise the minimum requirements, but it's never happened. Namely, the SEC has said, this is about the retail investor, and this is really their only access here, a pretty interesting access in the American securities framework that you really don't see in other markets, but no one's been willing to touch it. So it'll be very interesting if that moves forward and gets raised. What that will do, though, is put a lot more pressure on your larger institutional investors who will have a microscope put to their activities, because they're going to be the ones who could afford the tab to bring these shareholder proposals, and they're not used to doing it, and they'll see a lot of pressure. And you add that on with the stewardship code, which just came out by the large investors, and the governance principles. There's a couple sets out there. Sort of very interesting times to put the magnifying glass on what the large institutional investors will be doing.
Yeah, I mean, I'll disagree slightly in that I don't think that there could be any changes to 14A8 that are really going to change the recent dynamic of the movement towards a more shareholder-centric governance structure. I think it's taken on a life of its own. There are a lot of other mechanisms that shareholders can apply other than 14AA, including potentially proxy access, withhold campaigns on directors, and there are a lot of companies that have just started engagement programs, regular engagement programs with their large shareholders around corporate governance issues in particular, and the institutions are making their views known very clearly in that context. And so I think that shareholder-centric view has really taken on a life of its own. It's going to continue. I don't think anything that'll get modified for 1488 is going to really change that dynamic.
Particularly since they now have proxy access. That was the number one proposal that was made last year, and so shareholders have that tool. And I think a number of us were at an event in New York not too long ago, a few weeks ago, where there was a discussion from one of the key institutions that has been a proponent of proxy access, and there was a certain level of wavering as to whether or not that particular institution is getting ready to use proxy access, but that institution did admit to hiring some additional personnel to potentially support that effort. So maybe that's maybe even if we see 1488 get ratcheted down a little bit, or you probably are right that the train has probably left the station on the fact that the shareholders, particularly the institutions, expect to wield substantial amount of influence at the companies that they invest in. And I think maybe the last conclusion is that private ordering will be a term that we'll probably all be talking about a lot more, and that we will be seeing a lot more solutions being bandied about that take advantage of some kind of private ordering model that doesn't put the administration or the SEC into a mode where they need to issue a 100-page proposed rule and all kinds of economic justification and all that in order to comply with the Administrative Procedures Act, but more private ordering. So I think that is another preliminary conclusion that we could expect to see from as we think about the impact. But I think the most important thing we've said is that clearly, as we look forward, that the impact of the administration on activism is probably that the administration is going to be a catalyst, intentionally or unintentionally, on the further growth of shareholder activism. But that could not be because they're favoring activists versus companies. You might even take the position that because they are more on the company side and trying to help companies, that in and of itself counterintuitively favors activism. But so I think if we saw last year, if we saw 319, as FactSet would say, high impact activist campaigns, I think we're certainly going to be north of 300 in 2017. I don't think the trend is in any way going to reverse itself. Before we wrap up, any concluding remarks?
I think I'll just say, based on the last month, I think we can say with great certainty the next 11 will be very interesting to live through.
Yeah,
indeed.
Okay. Well, that concludes our event for today. I want to thank everyone for staying with us for the hour and in 16 minutes. Hope you found today's discussion interesting. I also want to thank our panelists for sharing their wisdom and insights with us today. To the extent you want to reach any of us, our contact info is included on the event webpage. You could also Google any of us, and I know we're all available via Google. our contact information fairly attainable. And if you're a Twitter addict like some of us, and particularly some of us who I also get up at 3 o'clock in the morning, feel free to continue the discussion using the hashtag Shareholder Activism. I want to remind everyone that an on-demand version, recorded version of today's discussion should be available either later this afternoon or tomorrow. And with that, I thank you, and everyone have a great day.
Thank you. This does conclude today's webcast. We thank you for your participation. You may disconnect your lines at this time, and have a great day.